Awesome. Looks like we are live in the Facebook group as well. So thank you guys for joining us there. Thanks for coming to underwriting deals in 2024 and protecting your downside. We wanted to host this webinar just for our investors, potential investors, partners, pretty much everybody in who's looking at multifamily real estate right now, how we're looking at multifamily deals, how we're underwriting deals. And really, our goal here is preservation of capital and growth of capital. 2024 has been a very interesting market. So we want to make sure we're not only achieving above average returns, but protecting our downside at the same time in a more volatile market that we've seen in the past. So no better person to run through that than Nick, our senior analyst and director of acquisitions. We brought on last year, so excited to kind of dive into how we're looking at deals right now and how you guys can take this and look at deals that are presented to you or deals of your own or our deals and take that and run with it.
Great. All right. Let's just jump right in. So we'll talk about in this presentation market analysis, location analysis, deal analysis, stress testing, and just the overall goal with when we're trying to purchase a deal and how we're thinking about downside protection, because that's really the name of the game for us is just don't become a forced seller and keep servicing that debt and then sell when the timing's right. And if you do that, then you're going to protect your downside and protect that principal for years to come. So we'll just go to the next slide here, and we're going to jump into market analysis. So the goal of market analysis is really more a high level, diving into markets that are showing strong historical trends and strong future forecasted trends. So our goal is to buy in strong markets. So, population growth trends need to be trending in the right direction, income growth, home value growth, and, declining crime trends is important. Buying in areas that have high crime is obviously not good, but if that crime is declining over time, it might be an interesting opportunity to buy if you're more of an opportunistic buyer. But this is more about protecting your downside. So not really looking to buy in too high of crime areas to start with. And obviously job growth is a big one, and being based in DFW, leading the nation here in job growth, it's a great spot to be. So some questions to consider when you're looking at the market. It's you got to look at your downside. How did this market perform during previous recessions? How did job growth and how did income growth perform? Did the population decline during 08? Did it power through? Did jobs power through? Did unemployment spike? Did labor force participation decrease? Just stuff like that to get your mind wrapped around at a high level the general market. And also look at how concentrated is the employment base. Is there a large concentration of oil that's driving these jobs, like West Texas, like North Dakota markets that are more volatile and oil dependent, or is it more tech focused? That's part of the reason why Austin's getting hit harder right now with rent decreases in some parts of Austin that have heavier concentration of tech jobs. DFW, obviously, there's probably over 16 markets here in DFW, and each one's different. But in general, there's a strong and diverse employment base here in DFW with finance jobs, transportation jobs, logistics, the whole span of industries that employ the population here.
Yeah, I think that's important to note. Like more than one anchor in a market is definitely more protection. In case that employer moves out, how much is affected by one industry. Oklahoma has, booms and busts with oil, certain markets will follow those kind of industries. And, depending on your appetite, you probably, one of the reasons why we're investing in real estate is to minimize those booms and busts, to minimize that. So it's definitely something important to factor when you're looking at that.
Yep. All right, we can go to the next one. So just some metrics that we'll look at and help kind of quantify some of these questions. Like we previously mentioned, this is just showing 4 different cities, Fort Worth and Arlington, very close to each other. Arlington being the city in between Fort Worth and Dallas. But yeah, we've got Fort Worth, Arlington, Rapid City, South Dakota, and Baltimore, Maryland. And here we're just looking at, how has population trended over the past decade or so. And obviously, Baltimore, yeah, you got some declining population growth there. So that's a red flag to start. Median household income growth over the past decade or two. Depending on where that first income level is at the beginning of the 2000 era, you might see some higher percentage growth metrics on that right slide there. But overall, pretty good metrics. I mean, not really surprising though to see this, as we've experienced some pretty crazy inflation, especially in the past 3 to 4 years. Median house or condo value. This is just showing home value appreciation over that time frame as well. Just kind of gives you a gauge of where these markets have appreciated. Crime index score. This gives you an idea of what I was talking about earlier. How has the crime trended over the past 15 years? Is it going up? Is it going down? You obviously want to see it going down and lower than that 400 measured index level is really the goal here. And we'll dig into it a bit more, just because, one of these metrics might be a little bit off. You can get more specific on location within a market to help kind of mitigate some of those risks that you might pick up on here. And then also job growth over the last 12 months, Rapid City experiencing some strong job growth on a percentage basis. Also very low unemployment up there, around 2% right now. And then also Fort Worth and Arlington and DFW as a whole, just consistently pumping out new jobs with strong population growth. So a very strong, fundamentally strong market in the Dallas-Fort Worth Metroplex. These are just some graphs to kind of help visualize not total non-farm payroll. And what I think kind of sticks out in these graphs, we'll look at 3 graphs here. This is just showing DFW, Dallas-Fort Worth, Arlington, MSA. But I just want to point out, during 2020 and 2008, those are the previous recession periods. Dallas-Fort Worth obviously experienced a decline in job growth there in 2020, but it recovered very quickly, and you'll be able to see, compared to these other 2 cities that we'll look at, it basically reached the peak of jobs prior to 2020. It looks like right before the end of 2022. So there was about a 2-year period where jobs didn't reach that peak point, but it has since surpassed that and is continuing to pump out job growth each report. So we'll go to the next one here, which is Kansas City. This is another market that we're pretty bullish on due to various reasons that we can discuss. But again, you'll notice in 2020, it recouped that job growth drop off by around 2022. So that market recovered fairly quickly as well. To see, it kind of just tells a story on market resilience and overall job performance of that market. After a recession, you can kind of gauge like how long will it take this recover. And I think job growth recovery timeline that we're looking at here is a pretty important way to gauge how strong a market really is. Go to the next slide here. Yeah, and then the next one here is just Baltimore. As you can see, job growth over time has been decreasing. Obviously, that's a red flag. And then during the last 2020 recession, COVID, really the total job count has not surpassed the previous peak. So you could pretty much say that the job market in Baltimore City, Maryland, um, has not really recovered in a sense since that last recession. So that's one of many reasons that we're not interested in investing there.
Yeah, and I think this is really good. So this is high level of a market. We're not investing in the Northeast. We're not investing in the West Coast, and these are kind of the metrics that we're looking at a market before we go, do a deep dive. So this is a macroeconomics that we're tracking of the markets. Something we didn't mention here. Business friendly, landlord friendly laws. We want to make sure, and sometimes not always, but a lot of times those are correlated with some of these numbers that we're seeing here too. New York City might have a ton of job growth. I don't know the population growth declining, but that's also something that we're looking at outside of that. So this is what we're looking at before we do a deep dive. So if someone sent us a deal in Baltimore, Maryland, hey, we got this really great deal in Baltimore, Maryland, we're immediately passing on that deal. We're not going in further. We're not looking at what part of Baltimore, or is it on this street, or is it close to good school districts. So that's high level on the market. And then, that kind of cues us up for next point here on the location and more micro level of an area. So I'll let you
Yeah.
from here.
So yeah, location analysis is just diving in a little bit deeper. If we like the macro, then just making sure that we like the micro. So yeah, we'll look at surrounding jobs in retail. What's really the employment base around the 1 to 5 mile radius of that location, of that deal that we're interested in. What are the crime reports showing us? Sometimes there's good pockets where there's very little crime. Sometimes there's pockets with high crime. Sometimes your actual property might have high crime in a low crime area, or sometimes vice versa, low crime property in a high crime area. So really digging into the crime reports and understanding what your asset and location actually is like. Also looking at home values in the surrounding area, age, especially if you're buying like a build for rent type property, what is your comparable property, townhomes or single family homes? What are those trading for? Similar vintage, similar square footage. What are those really trading for right now? To kind of give you an idea of the overall feel of that area. We'll also look at census block information, which gives you more specific information regarding how many families live in that specific census block. How's the population changed over the past decade or so? In general demographics of that actual census block. And then finally, we'll look at the school district and make sure that we're buying in a good school district. People like to live in good school districts. They'll pay premiums for rent, premiums on real estate to live in that area. So obviously, we want to be buying in the best school districts.
And this is very dependent on your business plan here too. So Nick kind of mentioned that, depending on your risk appetite, if you're buying a high crime, that's not really protecting your, to the theme of this underwrite. If you are not in a good school district, or, in a high crime area or low home values, you're not as protected on your downside. So something else in the deal has better be protecting you even more, and that's we'll kind of go into underwriting on what that means as basis or underwriting assumptions. Um, so it
Yeah,
looks
so on this slide, this is just touching on that first point surrounding jobs and retail. I mean, this is just from a broker deck on one of the last deals we closed on Madison Overland Park. But one of the large reasons that we like this deal a lot because it was in one of the best locations in Kansas/Missouri, right on that line right there. in Overland Park. So I mean, it's the actual site's located on Highway 69 right there. And in Overland Park, some of those homes are trading between $500,000 and $2 million. It's located in the best school district in the state of Kansas. There's a high demand to actually live in this neighborhood. There's generally low crime in this neighborhood. We'll look at a map of that a little bit later, but the generally surrounding retail and jobs in this area is very strong. And you've got good tenants. You got Apple, Dick's Sporting Goods, Pottery Barn, Starbucks, and a plethora of banking jobs, insurance jobs. And there's just a wide variety of demand in this area, which is something we definitely like to see.
Yeah, this hits all, like if you're looking for an A-class deal, if you look at this picture, this has just about everything you want to see in an A-class there. A Whole Foods, Starbucks, you know, Eric's favorite, crumble cookies. You know, if you have a crumble cookies, you're not a C-class resident isn't probably going to buy a $5 to $10 cookie. So that company is not going to strategically put their crumble cookies across from a C-class asset. Same thing with Whole Foods. You know, these companies right here are doing demographic research just like we are, and they're making large investments into the area based on their research. So, you know, follow the money, I guess you could say here. And this is Overland Park is a great example of that for A class. This is a institutional level market, where institutional equity is all over, placing funds in there. And that's why you can see, in these companies, investments in the area. So these are all good ones that we like to see, when we're targeting A class assets.
Yeah, this next slide, just looking at home values in that same area. Really just looking for long-term appreciation, no crazy booms or busts. And then, to complement this if we're underwriting a deal, we'd pull up the most recent asking prices and probably would hit up retail commercial, or sorry, not commercial, but a retail agent to ask them their thoughts on the overall residential market in that area as well. This is just, we're collecting data, we're getting a feel for the market, getting a sense of why people would really live there, to make sure that, this is a long-term sub-market and location that we want to invest in and really protect our downside, as the actual value of the real estate is going to appreciate. All right. Yeah. So crime reports touched on this briefly, but this is a specific crime report. And I don't know if you can zoom in a little bit, but I circled the blue box, which is our site, Madison Overland Park. This is just looking at I think it was a 3 or 4 month crime report window, time frame. And so basically, there's been some white collar crimes around there a little bit, maybe some more violent crimes around that shopping center to the right. But in general, there's been basically virtually zero reported crimes at the property in the last 4 months or so. So I mean, this is just confirming our thesis that this specific location is a low crime, high desirable location, which attracts high quality tenants and would result in low crime, low bad debt, low delinquency, et cetera. This is just showing a crime report of a high desirable location versus a not very desirable location. So I mean, these are two locations within Arlington, Texas. As you can see, over the same time period, one has 27 violent crimes against persons, and the other has 1 violent crime. So obviously, you don't want to be investing in the one on the left.
This is Arlington, and so I guess this is
they're both Arlington, but just different pockets within Arlington.
Oh, wow. Okay. Yeah, so that's not even, this isn't East Dallas, North, this is within a sub market here. So we're really looking at micro level here. These are both in Arlington.
Right.
And I would rather be walking over here in this part of Arlington than this part at night.
Right. Yeah, and then, digging a little bit deeper, we'll look at census block and, radius demographics. So yeah, if you look at the chart on the left, this is basically telling us for this specific census block, there's been 29% population growth over the last 10 years or so. So that little area has experienced some pretty good growth. The actual demographics in that area are shaded from lower ages to higher ages. So the majority of the census blocks made up from the age 25 to 34. The there's a certain number of renters in this census block. Let's see, there's about 52% of the renters are families. It's generally something that's pretty good. You want to see more families in the area. And let's see, what else do we have here? Yeah, renter occupied, household renter occupancy. This is really just, again, collecting more data to get a feel for the actual location. Is it a family-based location, or is it a more of a pass-through city location where there's a bunch of single people living and there's going to be more turnover and et cetera, stuff like that. And then the chart on the right here, this is just looking at forecasted population and household growth over the next 5 years. This is just sourced from CoStar, and there's probably a bunch of analytics and metrics that they're going to look at to come up with this data, but generally we want to see positive population growth forecasts and household forecast growth there, and stuff that's trending that positive direction. And then finally, the last part of the specific location is going to be the school district, just confirming that you're buying in areas that people want to send their kids to school, because that's going to increase demand and increase the real estate appreciation value over the long haul. So I mean, for this one, this is the Overland Park deal I was talking about, the best school district in Kansas. Over 3/4 of the teachers have a master's degree, which is really impressive, and a 97% graduation rate, and just really solid schools all around in that school district. All right. So now we'll talk about asset downside, which is more really deal specific, not really talking about location or market here. But assuming you like the location, you like the market, now you got to get to the deal and understand, all right, what's my actual risk here? What's my downside? And how do I actually mitigate that? So some questions to consider. How has the asset performed over the last 12 months? And what am I actually forecasting relative to that? Am I being too aggressive on my year one pro forma, or am I being more realistic? What was peak economic loss over the last 12 months? And really, why did it occur? Knowing why, certain months had spikes in occupant or vacancy and bad debt is sometimes questions that we'll ask up front on deals. Will I be able to service my debt if I reach that peak economic loss again? Take it a step further. Will I be able to service my debt if I reach max combined economic loss again? We'll talk about that in a minute. And then finally, will I be able to service my debt if I reach that max combined economic loss and also have zero rent growth, keep rents at current levels? That's a test that we're doing on a lot of our deals now to understand really what a downside cash flow perspective looks like. Obviously, it's a deal by deal basis, but that's something that we're definitely looking at. Another thing is reserves funded at closing to cover any projected shortfalls, to give yourself some cushion if you do experience one of these scenarios. How many units are achieving your year one underwritten rents? This is a big one, and understanding, you can plug in your unit mix rents and just say, all right, yeah, I'm going to get these rents within the first year, but really, there's going to be tenants that are going to be renewing, and there's tenants that are going to be moving in as new tenants. Those renewals are typically going to be lower trade outs, especially in this market with a lot of supply that we're experiencing right now because tenants have more selection as far as apartments to live in. So understanding, all right, how many units actually do I need to increase to hit my underwritten rents? And how am I going to get there? Another thing is NOI growth over the whole period and exit caps. I mean, those two metrics right there can make or break a deal. And then finally, your basis, sale comps, and replacement costs to kind of quantify what's my floor on this asset value today, or where's stuff really traded historically to my basis. So we'll get in the weeds on all this stuff here.
Yeah, this is really good. You know, this is all questions you should be looking at when you're going into whether you're getting just a T12 and a rent roll, or whether you're getting a broker pro forma, or you're getting another syndication pro forma. This is what we're looking at. You know, we're not just scrolling to the end and looking at what's our investor level returns. We're looking at, okay, what if these different scenarios happen? How can we protect ourselves in these scenarios? And essentially, we're making sure we're not a motivated seller where we didn't have correct debt or economic loss. This is kind of our targets for going after, you know, new properties, as if they've gotten into a situation somewhere here as far as existing deals. You know, so these are all questions you should be asking yourself and checking yourself as you stress test the deal.
Yeah. All right. So this slide here is just T12 analysis, just looking at the last 12 months of operational performance for an asset. So just some notes at the top here. The average economic loss over the last 12 months was around 12%. Peak economic loss was around 16%, which, yeah, it occurred in January. So that first month of analysis there. Max combined economic loss, which looks at the max physical vacancy, max bad debt, max concessions, and then totals that up. That would be 22% max economic loss. So if all those things hit at the same month, we would be hit with a 22% loss on GPR. So rents, another thing to note here is just looking at this T12, like color code, basically everything. It's just easier to see trends, but economic loss has been trending down since that first month in January at 16%. It reached a trough or a low point in June 2023 and July 23, probably when that leasing season's stronger. There's more demand for units as people are moving and it's warmer weather. And it's trended up a little bit since then. Vacancy specifically has trended up. But overall, you know, they've been pushing rents. Gross potential rental revenue has been increasing over the T12 period, and net rental income is up 8.9% from January 23 to December 23. So that's something to note here, and it kind of proves out if you're buying a deal and being pitched on a deal, this just helps your story as far as, hey, they're pushing rents, they're maintaining some level of stabilization at the property, where occupancy isn't getting out of vacancy is not getting out of control. So they're actually, you know, achieving some NOI expansion, assuming that they're keeping expenses in line here. So I mean, overall, you know, they've got a 56% OpEx ratio over this T12 period, and generally this is what you like to see: income trending up, expenses generally remaining flat, and yeah, the property's trending in the right direction. All right. So downside tests, kind of spoke on this briefly, but some tests that we'll look at when we're interested in a deal. We like the location, we like the submarket. Then we're getting really granular on the underwriting and understanding, all right, what's our downside actually look like here? This is just one of many things that we'll do, but at a high level, we'll look at, you know, what is the peak economic loss on this property over the last 12 months? Well, we just looked at it. It was 16% peak over the last 12 months. So if we hit that again, what does our cash flow really look like? And are we able to service our debt? because we're getting new debt on this property, we're adjusting for taxes, we're adjusting for insurance, we're adjusting our payroll, we're adjusting all of our operating expenses where we think we're going to be able to operate it. Generally, I'm not getting too aggressive on some of those expenses. I usually like to keep them somewhat in line with how they're operating it today, unless there's a clear indication that they're not managing it properly. But overall, if we stress tested to that 16% peak economic loss, we're still going to be cash flowing pretty comfortably. And this includes amortization on the loan, that principal payment there of $147,000 a year. So that's just some extra cushion, because on all of our deals, we're going to push for interest only payments just to give us, more cushion on our cash flow, because, like Brian mentioned, we're just trying to avoid becoming forced sellers here. So the more cash flow cushion that you can achieve, the less of a chance that you actually become a forced seller. So the next scenario here is looking at a higher level of economic loss. So it's looking at that 22% max combined economic loss that we looked at previously in that last slide. So in this example, there's the cash flow drops pretty significantly, but you still have some cushion. So you'd have roughly, $7,000-8,000 of cushion. It's getting pretty thin there. But really what I'd point out is our NOI from in-place NOI would be down 11% from in-place. And we'd still have cash flow to service our debt, including that amortization. So that's why, this deal feels pretty good right off the bat. And then max combined economic loss. So that last scenario, but now we're including no rent growth from leased rents. So we would basically be looking at, all right, where are their rents today on all their units? Let's match what they're achieving today. So basically no rent growth across the unit mix. And we're going to say we're going to have, catastrophic economic loss for the whole year. That 22% that we looked at. And in that case, you would be challenged to service your debt. You'd be roughly short $90,000, including that amortization payment. And this is really how one of the ways that we're trying to size reserves on deals is looking at this type of scenario, our third downside case. And we're saying, all right, in this 90,000 cash flow loss, let's size at least 2 to 3 times that amount to give us some operational reserve at closing. So we'll know and have, we'll sleep well at night in case, there's some crazy expense line items that we'll experience throughout the whole period that we just couldn't underwrite. A lot of these things that, you can't really underwrite 100% insurance increase. It's just not really feasible. But this is kind of how we're looking at protecting our downside on a cash flow basis on deals we're underwriting today, is protecting and adding some additional reserves at close in case you hit, max economic loss and no rent growth. All right, so a little deeper here on unit mix analysis. So this is just looking at a breakout of a unit mix for a deal. Each deal has a different unit mix. Each property has a different unit mix. This one's got 104 units. Total occupancy is 94%. Average in place rents are around $1,784 on occupied units. And then there's a nice mix of classics, premiums, and platinums. So there's a couple reasons that we really do this analysis. One, because it helps us tell a story on the rents and where they're at today. You can clearly see that there's a renovation premium between the classics and the platinums. The classics are getting around $1,707 chunk rent, and the platinums are getting $1,974. That's a $270 or so spread, which is a very nice renovation premium, depending on how much they're actually putting in these units to get that platinum level finish. And then we'll also do this to clearly see how many units are at or above the year one underwritten rent, and also vice versa below the year one underwritten rent. So in this case, if we if we basically match the year one underwritten rent to the average in place and assume no rent growth, there's going to be units that are above that rent and below that rent. So you're still going to have to increase 66 units to achieve that year one underwritten rent across the unit mix, because some of these unit types vary on those actual lease units. But in general, going to underwrite at least some of those units, usually like to have at least 10 to 15% of the units achieving that year one pro forma rent, just to prove out your business plan. Yeah, I already kind of talked about this, but reserves funded at closing. Um, you know, it depends on the deal and how strong the actual terms of the debt are. If there's really good assumable debt and good cash flow, then you might not need a ton of reserves at closing. But generally, deals are pretty tight right now to pencil, and we're gonna likely fund some operational reserves at closing in case we do run into one of those scenarios where we have spiked economic loss and no rent growth. So, for example, in that last deal we're talking about, we'd probably fund around $250 to $270,000 of reserves at closing. And if that's never used during the deal, it would just be returned at sale or through cash flow distributions, depending on how the deal's performing.
Yeah, I think that's good right there. And that's a fine balance between how much operational reserves do you have while deplete, your return on capital gets less if you just put in $1 million of operational reserves. Yes, you won't have any issues, but at the same time, your return on capital starts to get depleted. So, in the current market, we want to err on the more side of being conservative and make sure we're dialing in on those operational reserves. So, we're still capturing upside, but at the same time, we are capturing ourselves for those, downside scenarios.
All right. One of the more important two metrics to look
Looks
at.
like right here. Oh, you're kind of cutting out there, Nick.
Can you hear me?
Yeah, I can hear you now.
Okay, great. Yeah, so I mean, the next thing that we'll talk about here is NOI growth over the hold period.
It's cutting out again.
Break a deal. So really, if I'm gonna pass, that's the things that I'm probably gonna look at first. So for example, can you hear me?
You broke up there again right after you said NOI growth, hold, and exit caps. Yeah, you broke up. Try
Can
again.
you hear me now?
Yeah, I can hear you now.
Sorry, I think my internet might be getting a little faulty here. All right, well, I'll just keep talking here, and if I cut out, you can take over. But so yeah, we've got NOI growth and exit caps. So for this first example, and we'll do this on every deal and kind of stress test how NOI has changed over the whole period versus what's being achieved today. So yeah, this is a 7-year hold that we're looking at in this example. In place NOI is around $972,000 at exit based on a ton of different assumptions. We're saying we're going to get NOI to $1.2 million, which is a $229,000 increase. And over the whole period, it's 3.37% increase per year. And that's largely due to revenue and expense assumptions. So yeah, revenue, we're increasing 2.45% a year, and expenses, sometimes, you're buying below a taxable value in previous years. Sometimes you're actually getting insurance reductions. So that expense growth over the whole, that first year is really going to affect a lot of these expense growth metrics over a whole period. But in general, a 3.37% NOI growth over a whole period, that doesn't feel too aggressive to me at all. And let's see, yeah, I mean, under this kind of stress tested scenario, you're still getting a strong preservation of capital. This is more of a downside scenario that we're looking at here, by the way. You're still getting a 3% cash on cash, obviously not great. But you're getting a strong preservation of capital here, right? That's the goal, protect your downside. And even at a 5.55 exit cap, it depends on the market, depends on the asset type and location and all that. You're still getting a 1-2x equity multiple, 20% return on your capital on a 7-year hold period. This is more of a downside again scenario. And then we take it a level higher and we increase that exit cap 50 bips to kind of see, all right, what does my return on capital look like if we exited a higher exit cap there, lower sale price, and you're still getting your principal is still protected. That's really the goal here is at what point is my capital not protected? Am I losing money? And this obviously is very deal specific, so we can talk about exit caps and yield on cost and cap rates all day, but this is just a quick snapshot of NOI growth and exit caps to kind of gauge levels of risk for investments, real estate investments. And this next slide, we just drop NOI growth. Obviously, if you're buying a deal and you don't think you're getting any NOI growth, then you probably shouldn't be buying it in the first place. But this is stress testing your NOI growth to basically zero, exiting at that 5.5 and 6 exit cap. Really, what's my very low downside scenario look like? Well, I'd say you're probably at least going to get 60% of your capital back. So I would peg that as bottom tier, and I would be very surprised to see a property not generate some level of NOI growth well above this. But this is really just kind of framing, if the property did this, what would be the end result on my return. And really one of my favorite things to look at is basis, sale comps, and really where's your purchase price and where's your total basis relative to comps in the area. This really helps me quantify the floor of the acquisition. So for example, this deal in DFW, it's got a bunch of different sale comps here in different little pockets. So obviously something that's going to have to be factored into this analysis. Some of these locations and some markets are better than others. But just having all this data here is very important, and understanding, all right, well, I'm buying this property at $19.5 million at the bottom there, which is $187,000, call it $188,000 per door, $153 per net rentable square foot. That alone is well below the weighted average basis, except for one comp in Waxahachie and in Irving. I would dig into those a little bit, but really feel good about all at the purchase price basis, and also feel really good about the total cap basis, which includes closing costs, CapEx, fees, reserves, etc., which is $215 per unit and $176 per net rentable square foot. Both of those two numbers right there, we're well below where previous comps have traded. Obviously, some of these sales occurred at the peak, so you need to factor that into your analysis. And then, we'll also kind of ask a couple recent developers, like, hey, if you're going to build this similar product today, what would it cost you? Land costs, soft costs, hard costs, financing costs, etc. And that's just another thing that we're going to factor into this basis and floor analysis. And then a little bit more, I guess, on the right would just be more relative to income production and sale price per unit and sale price per net rentable square foot. So you generally want to see a higher percentage of your asking rent to sale price per unit and sale price per net rentable square foot. And in this case, again, color coding everything. The darker green ones are better, so you can see the subject here, it's got higher percentages on a asking rent and price per unit, price per net rentable square foot basis. So all good things there.
Yeah, I think that's super important to look at here. We're looking at, yes, your price per door, but also what is your total capitalization? If we're buying this property at 187,500 per door, okay, it looks good compared to these other price per unit, but we also want to make sure this total capitalization, lender costs, closing costs, acquisition costs, all that is going to factor in. The purchase price isn't the be all end all. You still have with everything you're going to put into the deal, maybe even capex into the deal too here. So this is really important, and obviously this is what you're looking at. Replacement costs, which Nick mentioned too, is super important. If we can buy a product today below its similar replacement costs, we're protecting our, downside if someone can't build it for that same amount. Especially when you're looking at asset specific. You want to factor in these locations, their year built, and that all that he kind of touched base on. It's not just doing a blanket of every single deal sold. We're giving certain weights to certain vintages. We're looking at these when they actually sold, and then even deeper here is their rentable. Per looking at the square feet. Um,
Yeah, I think that might be it as far as the presentation, but I mean, overall, I would just kind of conclude that it definitely feels like more of a buyer's market right now, than obviously 2021 and 2022. So it feels like a pretty good time to buy, and if you can get deals to pencil, and service your debt in these downside scenarios and make sure your downside's protected, then you're probably going to be okay in the long haul. So, we're doing this on every deal that we're looking at. And it's obviously tough to get stuff to pencil right now, but definitely a good time to buy, in my opinion. And I think the opportunities are out there.
Yeah, and to paint that clear picture, we brought on Nick last year to do just this. Has a great background. You can look up his bio on our website here, but this is what we're looking at, or what Nick is looking at day in, day out. Also looking at our current deals, how their underwriting is performing versus how we projected them, going back on that monthly basis. But it's April 15th right now. And the last deal we did was December 20th. That was the Madison at Overland Park deal that was our last acquisition deal. We have the rolling debt fund. That's a great investment to place in deals right now. But this specifically a new acquisition, we haven't done a deal since April, and these are what we've been doing. I think Nick mentioned, looked at high level, more than high level, 350 deals so far this year. And that doesn't include a broker sending you a deal and you're passing it, just, oh, that doesn't work. That's going into these deals and really having to underwrite them. And, it's hard to transact right now on all sides. And we're seeing that even on finding good deals. What specifically is making deals tough to pencil right now? There's a question, Nick.
Yeah, I would say it's a lot of uncertainty, and there's still lingering motivation. Sellers are still sometimes able to extend some of their loans, so they're not really forced sellers, and there's still a bid-ask kind of spread between what we want a deal to transact at and what the seller wants. Um, it's in the long and short, it's interest rates and really debt, the capital markets that have made it more challenging. Which I think it's kind of a good thing. It's more of a natural market right now with agency debt around 5.8, 5.9, than previously where bridge debt you get at like 2.5, 2.7. So it feels like a more normal market, where there's cap rates on C class stuff much higher than B and A class stuff. So, you have that dispersion of cap rates versus previously it was flatter across the board, like C class stuff and B class and A class were all trading at pretty similar cap rates. But what's really making it difficult is the debt and getting to some level of positive leverage, meaning, my debt constant um, is or my cap rate's going to be higher, or my yield on cost is going to be higher than my debt constant. That's really the challenge, just because where interest rates are today. So, I mean, we're looking at a lot of loan assumptions. We're trying to get creative with deals with seller financing to get deals across the finish line. But obviously, don't want to overpay on a basis standpoint. But if you can get to cash flow positive and really stress test these deals to a point that makes sense and you've high conviction in your assumptions, then that's really when I think it makes sense to pull the trigger.
Yeah, absolutely. And I think you nailed it on the head there. And obviously sellers' expectations, they having certain expectations for the exit, or whether they can't have to sell or not in a place to sell. Dry powder sitting on the sidelines, Blackstone making $10 billion investments. That's pushing up the basis there a little bit. And then our own expectations going into deal, where we're hitting home runs all the time in 2021 on exits, and it's having resetting some of those expectations for returns, but not budging on downside protection, and that's what we're looking at. And this next question kind of rolls into what you were talking about. Are you finding deals with low fixed rate assumable debt nowadays? I would think a low cost assumable loan would come at a premium now anyways.
Yep, I mean that's the pro and con. The loan assumptions are getting seeing a lot of those deals marketed, and the asking price on those generally is still not making sense, even if you're at a cash flow positive standpoint. And on those deals, I'm kind of looking at it from two lenses. One, if there wasn't a loan assumption, what would we look at the property value, and if we had to buy the asset with new debt today and not that accretive assumable debt, where do we value it today? And then two, I would also look at just replacement cost basis, sale comps, and all that to make sure on a price per pound, price per net rentable square foot, you're not overpaying. Um, those two things alone kind of make sure that you're not too far off on the pricing guidance there. And obviously, if the existing debt has plenty of term left on it, I mean, I would say at least 3, 4. I mean, I would love to get some 5-year remaining term assumable debt with a low rate and full IO. That would be awesome. Very hard to find. But yeah, it's a kind of pro and con type thing where you want to buy these assumable debt deals, but also don't want to overpay on basis. So every deal is different. So just weighing all the pros and cons of each.
Yeah, assumable loan is a great piece, and at the same, to Nick's point, you don't want to overpay for assumable loan, because you still have to sell the property for more than what you bought it for, in 5, 3, 5, 7 years, 10 years, however long your business plan is. So, you can maybe pay a little bit more because your cost of capital is, but you definitely have to be careful on that. And a good way to kind of go around that is, seller finance. If a seller will seller finance some of the deal, it can make it more attractive. Your cost of capital is less. It's not as infringing on the deal as your senior debt. So seller financing can be a way to kind of bridge the gap there, per se, to get a cheaper cost of capital to make a deal work. But again, still want to dial in on your basis. There's some really good questions. Crime safety report, George put some in the chat here. Spotcrime.com, crime grade, area vibes, community map. Those are in the chat. So we had this webinar from 6 to 7. If you guys had any additional questions, you can email us, info@elevatecig.com, or anyone on the team will reply to you right away. So excited to be doing these webinars more often, not just deal specific webinars. We had a lot of people reach out. Hey, are you guys pitching any deal tonight? No, not yet. We don't have our next deal yet, but definitely stay tuned. Nick and company are on the hunt, so we're close on some deals here shortly. But overall, just wanted to give you guys a very high level and even in-depth level view of how we're looking at the market, how we're diving in on deals and protecting the downside.
There are a couple questions coming in. Um, I could talk a little bit about multifamily versus other asset types. We've constantly looked at other asset types. We get things thrown at us all the time, asking if we want to sponsor storage or mobile home parks, RV parks, all types of stuff. And we kind of just go back to demand, right? And there's so much demand going towards multifamily rentals. The fact that purchasing a home now is so expensive, it's unaffordable for a good portion of the population, which drives more um, obviously demand for multifamily. Somebody always needs somewhere to live, right? And I'm not saying that these other, there's some attractive things to some of the other asset classes, but to us, we know the ins and outs of multifamily. We know there's a high demand for it, and that demand hasn't, if anything, it's only gotten stronger throughout the years. And that's why we decide to stay, in this space and stay highly focused in it.
Someone said, can you do a webinar about your debt fund? We have a replay. You can get that at elevatecig.com/invest-debt-fund. That replay is right there. I just put the link in the chat. So niche.com is one of your slides. Also, I see crime data. Can you share some other tools you use to analyze other location data on a micro level, home values, census block data, school district? George put some good ones in there. CoStar reports are very good. If you can get with the city's economic development, most large cities have some sort of economic development centers. So if you look up city, Northwest Arkansas, you can data, you can have NWA Council, or if you look at visitrapidcity.com, you'll find information on there. And a lot of times the cities themselves will have some really good market relevant data too. How to put a pitch deck together and be the GP. That's quite a bit. I think what Nick talked about right here, you want to make sure you're not just, you want to look at the market, you want to look at the debt, you want to look at who's running the deal, what's their operational level. That's George has some coaching, so you could look at the coaching there as far as being the GP. It definitely comes to, you want to make, if it's your first time, you want to make sure you have someone that's doing a lot of experience and operations. So definitely would starts with education. Would you invest in an A-B+ location, 1960s? Oh, here you go, Nick. Would you invest in an A-B+ location, 1960s build, 150 unit deal in Dallas, 6% plus year one pro forma cap in the current market environment?
I mean, I gotta get more details on it, but seems maybe interesting. It just depends on what's going into those numbers on the year one pro forma cap. I mean, 60s vintage is tough. You're probably gonna have a lot of stuff to replace, a lot of unforeseen CapEx items, roof replacements, boilers, all that stuff. 6 cap, you're probably I probably want at least like a high 6 cap, maybe 7 cap. Depends on the location, depends on the micro location and all that, but I would say, I mean, it's decently interesting if you're saying it's an A-B+ location.
Yeah, I would question that location a bit more. I don't see a lot of 1960s in an A-B+ location. I'm not doubting it, but I would look deeper into that and make sure that it really is that great of a location.
Awesome, guys. Well, again, we have I've got another meeting here, so, you guys these are all really good questions. Appreciate you guys, jumping on. If you have any more, info@elevatecig.com. Be in touch for the next webinar. And if you guys need anything else, let us know.
Thank you all.